let's go over Unit 46, which is Real Estate Math Calculations. Height of a triangular parcel is 800 feet, and the base is 450 feet. If the price per square foot is $930, $935, what's the cost of the parcel? Alpha 168,300, 168,300, 168,300. So to solve the problem, we need to calculate the area of the triangular parcel and then find the total cost based on the price and per square foot. Using the formula, area is 1/2 times base times height. So the base is what? 450 feet. Height is 800 feet. So area, you plug in the numbers, 1/2 times 450 times 800. And there you get 180,000 square feet. All right, so now you got the base, you got the area of the triangle. Now you want to calculate the total cost. So the price per square foot is 0.935 cents. So we multiply the area by the price per square foot to get the total cost. Total cost 180,000 times 0.935. It's going to give you 168,300. All right, again, second time, explain the question and answer. Height of a triangle parcel is 800 feet and the base is 450 feet. The price per square foot is 0.935. What's the cost of the parcel? So I'm going to calculate the area. Area is 1/2 base times height, and then you multiply by the square foot. So here's the breakdown. Here's 1/2 base times height. They give you the base and the height. You get the area, and then you multiply that by the 0.935 to get your total answer of 168,300. All right, so height of a triangle parcel is 800 feet, and the base is 450. If the price per square foot is 0.935, what's the cost of the parcel? So first, calculate the area of a triangle. It's 1/2 times the base times height, and then multiply by your square foot. You get the answer. A 1/2 acre parcel is 75 feet wide, and how deep is the parcel? Answer is alpha 290 feet. 290 feet. 290 feet. So to find the depth of the parcel, we need to use the area of the parcel, which is given as 1/2 an acre and the width. So step one, convert acres to square feet. So 1 acre is how many square feet? 43,560. 43,560. So 1/2 acre is going to be that divided by 2. So 43,560 divided by 2 is 21,780 square feet. All right, so then you want to use the area to find the depth. So think about a rectangle. It's just length times width, or the width times the depth. Now, the width is also called the frontage, so you got to remember that. So parcels are rectangular. So we can use the formula for the area of the rectangle. Here's width times depth. So we know the area and the width is 75 feet. So we can rearrange the formula, solve for the depth. So the depth is going to be your area divided by the width. They gave you the width, right? The width, the frontage, the width, 75 feet. So your area is 21,780 divided by 75, and you get 290 feet. So again, a 1/2 acre parcel, 75 feet wide. How deep is the parcel? So I'll explain again. Convert acres to square feet. How many acres or 1 acre is how many square feet? So 1 acre is 43,560 square feet. Right? And they only want 1/2 acre. So you take 43,560 divided by 2, you get 21,780. And then areas with width times the depth, you have the area. Takes your area divided by the the width, and you get 290. 1/2 acre parcel is 75 feet wide. How deep is the parcel? So area is so they want 1/2 acre. How many square foot is in 1 acre? 43,560 square feet is 1 acre. Take that divided by 2, you get 21,780 square feet. Area is width times depth. You got the area now. You need to know how deep is it. You got the width. They told you the frontage or the width. Take your depth. Take the area divided by the width. You get 290 feet as the depth. An acre of land is divided into 3 equal rectangular lots, each with a depth of 191 feet. What's the frontage of each lot? Answer is alpha, 76 feet. 76 feet. 76 feet. So find the frontage of each lot. We need to use the total area of 1 acre and divide it into 3 equal rectangular lots with a given depth. So convert acres to square feet. We know 1 acre is what? Is 43,560 square feet. So you're going to divide the area by the number of lots. So how many lots do they want? 3. So take 43,560 square feet divided by 3. Now you get 14,520 square feet. So you use the area to find the frontage, which is the width, right? We said width, which is the frontage, not the depth. That's the width. The width, how wide. So you're going to go to the zoo. You want to look at some giraffes. That width, right? The frontage, that's the front part of you're looking at. That's called the frontage. The width, how wide is it? Now depth, that's not frontage. That's just the depth. So here's the width times depth. They want to know the width now is area divided by depth. So the 14,520 divided by 191 gives you 76 feet as the width. Again, an acre of land is divided into 3 equal rectangular lots. So right away, you know you're going to take 1 acre, which is 43,560 square feet, 43,560, divided into 3, and that's the area. And then, you know, area's width times depth. So you got the area, you got the depth, they want the width, which is the frontage, and you take your area divided by the 191, you get the 76 feet. So the area is 14,520, the width is the 14,520 divided by the 191 to get you the 76 feet. Acre of land divided into 3 equal rectangular lots, each with a depth of 191 feet. What is the frontage of each lot? So 1 acre is what? 43,560 square feet. So take 43,560 divided by what? Divided by 3 to get you 3 equal rectangular lots, each of them, right? So you got giraffes, right? You could have like fish and something else on the other one, probably not. And then you take that area divided by the depth and you get the width. In order to claim ownership under adverse possession, a claimant must show they possess the property for a minimum of, Charlie, 10 years. 10 years. 10 years. So, adverse possession laws allow a person to claim ownership of property they occupy for a certain period of time, openly and continuously without the permission of the original owner. The specific time required varies by jurisdiction, but a common minimum period in many places is 10 years. So in order to claim ownership under adverse possession, a claimant must show they possess the property for a minimum period of 10 years. Right? So adverse possession is that you need it to have for 10 years. A $36,000 loan has a monthly principal and interest payment of $270. So we have to remember PITI. PITI stands for principal, interest, taxes, and insurance. PITI. PITI. So they give you the interest and the principal. What's the total amount of interest paid over the 20 years? So they don't give you interest. They give you the principal. They give you the time. Answer is 28,800. 28,800. 28,800. So determine total amount paid over the life of the loan. Monthly payment is what? Is $270. The loan term is 20 years. So you take 20 times 12. Why do you do that? Because you're getting years. um, Actually, it's divided by 12, right? So 20, you get 240 months. Total amount over total amount paid over 20 years is going to be the monthly payment times the total number of months. So 270 times 240, it's going to be 64,800. So you're taking your monthly payment and your time frame. So $270 over so many months, and that's your amount paid over the life of the loan. Then you want to calculate the interest. So the total loan principal is 36,000, and so you take your principal and you subtract the interest. Subtract the loan principal. You get 28,800. So a $36,000 loan has a monthly principal and interest payment of $270. What's the total amount of interest paid over the 20-year life of the loan? So again, you want to take the 20 years, multiply by 12 to get the number of months that you're going to have to make the payment over the 20 years. And then multiply by 270 to get the total amount of interest. And then, total amount of principal, and take the principal minus the 36,000, and you get 20,800. $36,000 loan has a monthly principal and interest payment of $270. What's the total amount of interest paid over the 20-year life of the loan? So take 20 years times 12, you get those number of payments you're making, times $270. You get a number, take that number, minus 36,000, you get the 20,800. Increase of 1% in interest rate is equivalent to an increase of how many basis points? Answer is Charlie, 100. 100. 100. So increase of 1% in interest, right? 0.01 is equivalent to an increase in 100 basis points. So 1 basis point is defined as 0.01%. Therefore, a 1% increase in the interest rate is equivalent to 100 basis points. So 1% is 1 times 100, which is 100 basis points. Increase of 1% in interest rate is equivalent to an increase of how many basis points? So again, 1 basis point is defined as 0.01%. Therefore, 1% increase in the interest rate is equivalent to 100 basis points. So an increase of 1% in interest rate is equivalent to an increase of how many basis points? We said 100. 1% is 1 times 100, which is 100 basis points. If the seller agrees to carry back 30 grand for 30 years, has 7.2% interest, and the monthly payment of $203.64, what's the remaining loan balance after 3 months? Charlie, answers Charlie, 29,928. 29,928. 29,928. So define remaining loan balance after 3 months, given that the loan amount, interest, annual interest, monthly payment, long term, 30 years, which is 360 months. Your payments made, they told you in the problem it was after 3 months. So that's 3 payments you made. So you convert annual interest to monthly. So how do you do that? Take 7.2% divided by 12 to get it in months. So that's 0.6% per month. 0.6% is 0.006. And this one, I'm going to pause here. We need to do this one. Look at this formula. I think ChatGPT did it wrong. Like, that's not real. Like, what the fuck? Like, we're not gonna lie. That's slide 18. If you can figure out how to do that one. Keep going. What do you need to do? Is $200. What is the remaining loan balance after 3 months? Charlie, 29,928. 29,928. 29,928. So, to calculate the remaining loan balance after 3 months, you need to determine how original $30,000 balance has been paid off by the monthly payment at 7.2% annual. So let's calculate the monthly interest rate. So how do you do that? We take the interest, divide it by 12, you get the monthly interest rate. 7.2% divided by 12 is going to be 0.6% or 0.006. The monthly payment, the question provides the monthly payment as $200. Each payment goes partly towards paying interest and partly towards reducing principal. So for each month, calculate the interest on the remaining balance. Then subtract from the payment to determine how much goes towards reducing the principal. Step by step for each month. So month 1, interest is $30,000 times 6%, $180. The principal portion of the payment is going to be the $203 minus $180. That's $23. The new balance is 30 grand minus $23. Brings you to 29 grand. Month 2, interest is 29 grand times 6% again. Now it's $179. So before we did the balance of 6% of 30 grand, but now we're doing 6% of 29 grand. So the principal on that is going to be $200 minus 179 gives you $23. Now the new balance is 29 grand 976 minus $23, you get 29 grand 952. Month 3, interest is going to be 6% of 29,952. That'll give you 179. The principal is $203 minus 179 is $23. What's the new balance? It's going to be 29 grand minus the $23 gives you 29,928. So again, if a seller agrees to carry back $30,000 for 30 years at 7.2% interest, and the monthly payment is $200, what's the remaining balance loan after 3 months? So right away, you need to go get 7.2% in the daily. So 7.2% divided by 12, the monthly, and you get 0.6%. The question provides the monthly payment as $203. So what was the monthly payment? That's actually given in the problem, $203.64. So each payment, right? So you're going to be using that 3 times for 3 months. So month 1, you get the interest, principal, and new balance. Month 2, interest, principal, new balance. Month 3, interest, principal, and new balance. So if a seller agrees to carry back $30,000 for 30 years at 7% interest and the monthly payment is $200, what is the remaining loan balance after 3 months? Charlie, 20,920. So again, you take your monthly rate, get it in, or your yearly rate, 7.2, get it into months, divide by 12, and then take your payments, right? Each payment goes partly towards paying interest and paying towards reducing the principal. So for each month, you want to calculate the interest on the remaining balance and subtract from the payment to determine how much goes towards the reducing the principal every month. So month 1, you get the interest. The principal and the new balance, and the same thing for 2 and 3. End up with 29,928. Yeah, I'm gonna keep going. Okay, so the annual net income from a shopping center is 2 million. The buyer wants to obtain a loan for 60% of the 30 million purchase price at an interest rate of 6.75%, amortized over 25 years, with monthly payments of 120,000. The loan is made at these terms. What is the debt coverage ratio? It is Bravo 1.39. 1.39. 1.39. So calculate debt coverage ratio is the net operating income divided by the debt service. The net operating income divided by the debt service. So they gave us the annual net income, $2 million, was the monthly debt payment is $120,000. So to calculate the annual debt service, since the monthly payment is $120,000, the annual debt service is going to be $120,000 times 12. So going from monthly to yearly. So how to do that? Multiply by 12. So you have $120,000 per month times 12, gets you 1.4 million per year. So you calculate the debt average ratio is going to be the 2 million, the net operating income divided by 1.4 million, and the debt coverage ratio is 1.39. The annual net income from a shopping center is 2 million. The buyer wants to obtain a loan for 60% of the 30 million purchase price at an interest rate of 6.75%, amortized over 25 years with monthly payments of 120,000. If the loan is made at these terms, what is the debt coverage ratio? So again, what's the debt coverage ratio formula? It's going to be the net income divided by the yearly service, right? So take 2 million divided by what is the yearly service? So take the payments of 120,000 multiplied by 12. You get that's the yearly, and you get your debt coverage ratio. So debt coverage ratio is net operating income divided by the debt service. 2 million divided by the 120,000 times 12, which is the 1.44 million, 1.39. Annual net income from a shopping center is 2 million. Buyer wants to obtain a loan for 60% of the 30 million for purchase price, an interest rate of 6.75% amortized over 25 years, with monthly payments of 120,000. So notice that second line is all non-needed information, right? We don't do anything with the 60% or the 30 million or the 6.75% amortized over 25 years. Debt coverage ratio is literally just the income divided by the debt service. So don't be tricked by that. So 2 million divided by the 120,000 times 12. Which of the following conventional loan percentages requires private loan insurance? Delta 90%. 90%. 90%. So PMI, what is it? It's private mortgage insurance. So it's when you is generally required for conventional loans, when the loan to value LTV ratio is above 80%. So anything over 80%, you need PMI. So this means if a borrower puts down less than 20%, right? So if he puts down less than 20%, say 85, 86, 90, 95, that's less than 20% of the home's value, or borrows more than 80%, PMI is typically required by lenders to protect against potential default. So answer A, 70%. No, they put down how much? They put down like 30% down payment, right? So 100 minus 30, that brings you to 70. So you don't need PMI. How about 75%? No, they don't need PMI. They put more than 20% down. How about 80%? No, if you're right at 20% down payment, put you at an 80% loan to value, you don't need PMI. 90%, yes, they need it. They only put down 10% of the down payment. So it brings it 100 minus a 10, so you get 90%. So PMI is required, right? Because the loan to value is over 80%. So you can't have, more risk, right? The bank wants to de-risk, and they think, if you don't have more than 20% down payment, then you need PMI, you need private mortgage insurance. So which of the following conventional loan percentage requires private loan insurance? It is delta 90%. Property is purchased for $280,000 with a 95% loan. The lender requires a PMI charge of 0.78% to be paid 1/12 each month. What's the monthly charge for PMI? Answer is alpha, $172. $172. So to calculate the monthly charge for PMI, so they give you the property purchase price, $280,000. The loan is 95%, meaning it's a 5% down payment. What's the PMI rate? It was 0.78% annually. What is the monthly payment? Calculate the loan amount. The loan amount is going to be the $280,000 times 95% to get you $266,000. That's the loan amount. So you take that loan amount and you multiply it by the PMI rate. So 266,000 times 0.0078, and you get $2,074,000. So what's the monthly PMI? Well, take that number, that's annual, you divide it by 12 to get the monthly. 2 million divided by the 12 gets you $172. That's the monthly PMI payment. All right, property is purchased for $280,000 with a 95% loan. So right away, you can multiply those two numbers to get the total loan. Lender requires a PMI charge of 0.78% to be paid 1/12 each month. What's the monthly charge for PMI? The monthly charge for PMI. So take 280,000, multiply by 95%, that's the total loan, and you multiply by the 0.78%. Now it gives you 0.78%. So it's a trick question. 0.78% in decimal is 0.0078. So 280,000 times 95% is the 266. That's the total loan amount. The annual PMI is the 266 times the 0.0078, and then you divide by 12 to get the monthly. You get $172. Property is purchased for $280,000, 95% loan. So right away, multiply those two to get the loan, total loan. Then you multiply by the 0.78%, divide by 12, and you get the monthly PMI. So $172, that's the monthly private mortgage insurance payment. Property is sold for $50,000 with a 10% down payment and a $40,000 loan. If the lender charges 4 points, the discount paid will be Charlie $1,600. $1,600. $1,600. So understanding points, so each point is 1% of the loan. So 4 points would be 4% of the loan. So since each point is 1% of the loan, total discount will be 4% times 40,000 is 1,600. So here's kind of tricky. Property sold 50,000 with a 10%, $10,000 down payment and a $40,000 loan. If the lender charges 4 points, the discount will be paid what? So here you need to recognize one discount point is 1% of the loan. So take four points, which is 4% of the loan. The loan is 40,000. 4% of 40,000, 4 times 4 is 16, so $1,600. If the percentage of renters in a community exceeds 50%, many lenders require that the homeowners association reserves be what percentage of HOA budgeted income? 20%. 20%. 20%. So 20% figure is just a standard guideline in the lending industry and serves as a safeguard for properties with higher rental occupancy to maintain property values and cover unexpected costs. So if the percentage of renters in a community exceeds 50%, many lenders require that the homeowners association reserves be what percentage of HOA budgeted income, and it's 20%. So for communities with more than 50% renters, lenders commonly require the HOA to have at least 20% of its annual budget set aside in reserves. So, you live in a community, you got more than 50% renters. How much does HOA require to have in their budget? It's 20%. All right, property sold for $200,000 with the buyer paying a 25% down payment. The lender will charge 2% in discount points. The discount will be, bravo, $3,000. $3,000. So calculate the loan amount. So since the buyer's making a 25% down payment, they're financing 75% of the property's price. So the loan amount is going to be the property price times 1 minus the down payment percentage. So $200,000 times 1 minus 0.75 to get you the 0.75. So 200,000 times 75% is 150,000. That's the loan. So now you want to calculate the discount points. Discount points are calculated as a percentage of the loan. So lenders charges 2% in discount points. So 2% of 150,000. So that's $3,000. So property sold for $200,000 with the buyer paying 25% down payment. So again, 2% is the discount points. So 2% of the loan, what's the loan? So we got to figure that out. So the property price is $200,000, and the buyer put down 25% down payment. So that's 75% of 200,000, which is 150,000. 150,000 times 2% of that's the loan amount. It's 150,000. That's the loan amount. Discount point is 2% of the loan, which is $3,000. Property sold for 200,000 with the buyer paying 25% down payment. If the lender will charge 2% in discount points, discount will be what? So we need to get the loan. They sold it for $200,000. They put down 25%. So we need the what is the loan? So 200,000 times 75%, right? 100 minus 25 will give you 75%. That's the loan. 200,000 times 75% give you 150,000 times 2% gives you $3,000. Property sells for 129,500. How much cash will the buyer need at settlement if the buyer will pay 20% down? A 2% origination fee for the mortgage and $750 in closing costs. 28,722. 28,722. 28,722. So here, what's the down payment is going to be the sale price times the down payment percentage. So what's the sale price was 129,000. The down payment was 20%. If you multiply those two, you get the total down payment. So that's 25,900. Now we want to calculate the total loan. So it's 129,500 times, right? How much they put down? 20%. So loaned value LTV. So 129,500 times 80%. That's LTV. To get 103,000. That's total loan. 103,600 is total loan. Loan amount times the origination fee, which was the 2% of the loan amount. So now you get $2,000, and then you add the closing costs. You get 2,000. So the total cash needed is going to be the down payment. What's the down payment? So it's 25,900 plus the fee of 2,000 plus the $750 closing costs. So you get 28,722. That's the total cash needed. Okay. Property sales for 129,500. How much cash will the buyer need at settlement if the buyer will pay 20% down, a 2% origination fee for the mortgage, and $750 in closing costs? So how much cash you got to bring to the table? Kind of an important problem. So here, he's got to bring 28 grand cash. So he's got to calculate the total down payment. 129,000 times 20% gives you 25 grand. The total loan he's putting 20% down, so it's 129,000 times 80%. Then you calculate your fee, which is going to be 103 grand times your 2% is $2,000. Total cash is going to be your closing costs, your origination fee, and your down payment. So you add those three things up. The closing cost is $750. Your origination fee, right? The MLOs, the mortgage license originators, they have an origination fee. It's $2,000. And then your down payment is 25 grand. You buy a small apartment complex for $275,000. You finance 80% of the purchase price on an interest-only loan at 5.5%. Your net operating income is 27 grand. What is your cash on cash return? It is delta 28%. 28%. 28%. So here the property price is $275,000. Your down payment is 20% of that, so you get 55 grand. You want to calculate the annual debt service, which is the interest payment. So the loan is 80% of 275 grand is 220. Your annual interest payment is going to be 55% times 220,000 is $12,000. And then you want to calculate your cash flow. So that's your net operating income. So take the net operating income, which is the 27,250 minus the 12,100, and now that's your cash flow. Cash flow is your net operating income minus the debt service, gives you $15,000. And now you want to calculate your cash on cash return. Cash on cash return is literally calculated based on your cash flow. So cash on cash return is equal to cash flow divided by down payment. So cash on cash return is cash flow divided by down payment. Cash on cash return is cash flow divided by down payment, multiplied by 100. So cash on cash return is going to be, what's the cash flow? 15 grand. What's the down payment? 55 grand. So 15 grand divided by 55 grand times 100, that gives you 27.55%. And you round up to 28%. So that's your cash on cash return. So you buy a small apartment complex for $275,000. You finance 80% of the purchase price on an interest-only loan at 5.5%. Your net operating income is $27,250. What's your cash on cash return? Step one, let's calculate the down payment. So 20% of 275, that's $55,000. Your loan amount is 80% times 275,000, that's 220. Your annual interest payment is the 55% or 5.5% times 220 gives you the 12 grand. Your cash flow is your net operating income minus the debt service, and then cash on cash is the cash flow divided by down payment. So you buy a small apartment complex for $275,000. You finance 80% of the purchase price on an interest-only loan at 5.5%. Your net operating income is $27,250. What is your cash on cash return? So again, you want to get the loan value, you want to get the total cash. Your cash on cash return is going to be the cash. The cash on cash return is the cash flow divided by down payment. So we got to calculate the cash flow, and we got to calculate the down payment. So down payment is 20% of 275,000. So that would be your down payment, and then the cash flow is the net operating income minus the debt to give you 15,150. Using the market data approach, the subject property has a fireplace, which you estimate to add $1,000 in value. Comp number one does not have a fireplace, but does have a pool, which you estimate to add $2,000 in value. Which way do you adjust the sale price? So the answer is delta, down $1,000. Down $1,000. Down $1,000. So here you want to identify the difference in value. The subject property has a fireplace, adding an estimated $1,000 in value. Comp number one has a pool, adding an estimated $2,000 in value. So you want to calculate the net adjustment. So because yours had 1,000, the pool had 2,000, so you would adjust it by taking it down 1,000 so that they're equal. Right? So that's why its answer is down 1,000. So since the subject has a fireplace worth plus 1,000 but no pool, the comp number one has a pool and it's worth plus 2,000 but it doesn't have a fireplace. We compare these values. The difference is 2,000 minus 1,000 gives you 1,000. So take it down 1,000. All right, using the market data approach, the subject property has a fireplace, which you estimate to add $1,000 in value. Comp number one does not have a fireplace, but does have a pool, which you estimate to add $2,000 in value. Which way do you adjust the sale price? So again, to make comp number one comparable to the subject property, we need to decrease the sale price of comp number one by down $1,000, since the pool adds more value than the fireplace does, than the fireplace alone. So using the market data approach, the subject property has a fireplace, which you estimate to add $1,000 in value. Comp number one does not have a fireplace, but does have a pool, which you estimate to add $2,000 in value. Which way do you adjust the sale price? So to make comp number one comparable to the subject property, we need to decrease the sale price of comp number one by $1,000, since the pool adds more value than the fireplace alone. A property has a gross income of $250,000 and expenses of $100,000. If an investor buys the property, puts $700,000 down, and the annual mortgage payment is $90,000, what is the investor's cash on cash return? Bravo, 8.57%. 8.57%. 8.57%. So here we want to calculate the cash flow after debt service. So what is the annual mortgage payment? It's $90,000. So the net operating income is $250,000 minus $100,000, give you the $150,000. The cash flow after the debt service equals the net operating income minus the annual mortgage payment. So $150,000 minus $90,000 gives you $60,000. The initial investment, which was the down payment, $700,000, and your cash on cash return is going to be the cash flow after the debt service divided by your initial investment, which is the down payment. So 60,000 divided by 700,000 times 100 is 8.57%. So again, a property has gross income of 250,000 and expenses of 100,000. If an investor buys the property, puts $700,000 down, and the annual mortgage payment is $90,000, what is the investor's cash on cash return? Well, cash on cash return, we know it's the cash flow after debt service divided by the initial investment, aka your down payment. So to calculate the cash flow after the debt service, it's going to be 150 grand minus 90 grand is 60 grand, and then they told you put down 700 grand. So 60 grand divided by the 700 grand, it's 8.57%. So what is the investor's cash on cash return? 8.5% is pretty good. When an appraiser is performing an appraisal on a property, what is the minimum number of comparables to be used under the direct sales comparison? C, it is 3. 3. When an appraiser is performing an appraisal on a property, what's the minimum number? So direct sales comparison approach involves comparing subject property with recently sold properties that are similar in characteristics, location, and other relevant factors. The minimum number of comparables recommended is typically 3. So when an appraiser is performing an appraisal on a property, what's the minimum number of comparables to be used under the direct sales comparison approach? So 3, this is based on appraisal industry standards. Using at least 3 comps helps provide a more balanced and reliable estimate to the subject property's value. A rental property has 6 rental units that rent for $700 each per month. A similar property in the area sold for $700,000. What would be the annual gross rent multiplier for this type of property? Delta 13.8. 13.8. So here you want to calculate the total annual rent. So the monthly rent is $700. There's 6 units. $700 times 6 is $4,200. That's the monthly rent. So to get it into annual, what do? Multiply it by 12. So 4,200 times 12 is $50,000. That's per year. It's annual. So now you want to calculate the gross rent multiplier, the GRM, gross rent multiplier. So gross rent multiplier is the sale price divided by the annual rent. So $700,000 divided by $50,000, because that's the annual rent, is 13.8. So gross rent multiplier is sale price divided by annual rent. Gross rent multiplier is sale price divided by annual rent. Gross rent multiplier is sale price divided by annual rent. So a rental property has 6 rental units that rent for $700 each per month. So what do there? Right away, 6 times the $700 per month, and multiply by 12 to get the annual rent. Similar property in the area sold for $700,000. That's your down payment. What would be the annual gross rent multiplier? This type of property. So gross rent multiplier is sale price divided by the annual rent. So what was the sale price? Well, as told you in the problem, similar property in this area sold for $700,000. So gross rent multiplier is going to be $700,000. That's the sale price, or similar, divided by the $50,000. An apartment building has a total income of $140,000 per year. The yearly expenses are taxes, $18,000, repairs, $3,000, insurance, $10,000, and miscellaneous expenses, $7,000. If a buyer pays $720,000 for the building, what will be the net return? Alpha 102,000. 102,000. So here you want to calculate the total expenses. So taxes, $18,000. Repairs, $3,000. Insurance, $10,000. Miscellaneous, $7,000. So that's $38,000. That's the total expenses. Okay, so let's go back to the problem. Apartment building has total income of $140,000 per year. Yearly expenses are taxes, repairs, insurance, miscellaneous. Anytime they give you a list like this, you're probably going to have to add it all up. The net return is total income minus total expenses. So total income is $140,000. Total expenses is $38,000. So the net return is $102,000. An apartment building has a total income of $140,000 per year. So right away, that number is going to be subtracted against a bunch of expenses. So the yearly expenses are taxes, repairs, insurance, and miscellaneous expenses. If a buyer pays $720,000 for the building, what would be the net return? So here, right away, take 140,000, that's what came in. So income minus what went out, 38,000, you get 102,000. So notice that it didn't matter, right? They put in if a buyer pays 720,000, that didn't matter. So an apartment building has a total income of 140,000 per year. Yearly expenses are taxes, repairs, insurance, and miscellaneous expenses. If a buyer pays 120,000 for the building, what will be the net return? So net return, so it's just what's coming in minus what's going out. So 140,000 minus all those expenses, you get 102,000. A commercial space pays $400 per month and rents for 4% of their $750,000 annual income. What is the average monthly rent? It is Charlie, $2,900. $2,900. 2,900. So since this is an annual amount, we convert it to monthly amount. Take 30 grand divided by 12. You get 2,500. So what's the base rent? It's $400. Annual income, 750 grand. 4% of the annual income, 750,000 times 4% is 30,000. What's the total average monthly rent? Total average monthly rent is the base rent plus the monthly percentage rent. So it's 400 plus 2,500 to get you 2,900. So commercial space pays $400 per month for rent and 4% of their $750,000 annual income. What is the average monthly rent? So the total average monthly rent is the base rent. They gave you the base rent, $400, plus the monthly percentage rent. That's the real number to figure out. So the monthly percentage rent is the annual income of, so they take the commercial space is 750 grand times the 4%, and then divided by 12, you get 2,500. So the monthly percentage rent is 2,500 plus the 400 gives you 2,900. Commercial space pays $400 per month for rent and 4% of their $750,000 annual income. What is the average monthly rent? So average monthly rent is the rent plus the monthly percentage rent. So $400 plus a number, right? So take 750 grand times 4% and divide it by 12 to get 2,500 plus the 400 you get 2,900. Okay, so the buyer wants 11% return. The property rents for $1,500 per month. And annual expenses are $4,000. What is the price the buyer is willing to pay? It is C, $127,000. $127,000. $127,000. So to calculate the annual income, the property rents for $1,500 per month. 1,500 times 12, that's 18 grand. So the annual rental income is 18 grand. Calculate net operating income. Annual expenses are $4,000. We subtract from the annual rental income 18 grand minus 4 grand, give you 14 grand. So the net operating income is $14,000. Determine the property price for an 11% return. So price net operating income divided by desired return. They want the 11%. So 14 grand divided by 11% gives you 127,000. So like say an investor, they say, hey, I want 11% return. Well, you can calculate the price based off of the desired return and the net operating income. So if someone puts the price of a property and they're not generating enough net operating income based on your desired return, you can get that right here in this calculation. This is a very good problem to do if you're going into investments. So the buyer wants 11% return. The property rents for $1,500 per month, and the annual expenses are $4,000. What is the price the buyer is willing to pay? So the price he's willing to pay is $127,000, right? Because the price is going to be the net operating income divided by the desired return. They want 11% of their money, so they need to figure out the net operating income. So the net operating income is going to be the rent times 12 to get the yearly minus minus the annual expenses. So now you can calculate the price is going to be net operating income divided by the desired return. A property that produces $3,000 in net income per year was valued using a capitalization rate of 7.5%. Its value is $40,000. $40,000. $40,000. So the value is equal to the net income divided by the cap rate. $1,000 in net income per year was valued using a cap rate of 7.5%. Its value is what? So to find the value is the net income divided by the cap rate. So what's the net income? And the problem is at 3,000. What's the cap rate? 7.5%. 7.5% is 0.05 in decimal. So take $3,000 divided by 7.5%. You get $40,000 straight. So a property that produces $3,000 net income per year, right away, if you're going to know value is just the net income divided by the cap rate. So the cap rate, they give it to you straight up 7.5%. So they give you two out of the three variables, right? So the value is going to be $3,000 divided by 7.5%, which will give you $40,000. That's how much the property is going to be valued if it's bringing in that much money per year. So a property that produces $3,000 in net income per year was valued using a cap rate of 7.5%. Its value is what? So value is income divided by cap rate. That'll get you the value. Real estate sale was closed on March 21st. The assessed value of the property is $72,500. The tax rate is $1.75 per $100 of assessed value. What is the proper entry on the seller's settlement statement? Answer is C, 281.94. 281.94. So here we're going to calculate the annual property tax. Annual tax is going to be $72,500 divided by 100, and you multiply by $1.75. So that'll get you $1,268. That's the annual tax. Now to get the daily tax amount, you take the $1,268 and you divide it by 365 days. You get 3.4. That's the daily tax. Now to calculate the seller's portion, it's going to be 80 times 3.4, and that'll get you $278. So the closest answer to the calculation is approximately 281 as a debit, since it's the seller's responsibility, which matches option C. So the property sale closed on March 21st, which is the 80th day of the year. January has 31 days. February has 28 days. March has 21 days up to the closing date. So the seller is responsible for property taxes from January 1st to March 21st. So you multiply the daily tax amount by the number of days the seller owns the property. So real estate sale was closed on March 21st. The assessed value of the property is $72,000. The tax rate is $1.75 per 100 of the assessed value. What is the proper entry on the seller's settlement statement? What is the proper entry on the seller's settlement statement? Is it a debit? Is it a credit? So this is for the seller. So you want to calculate the annual property tax. So take the $72,500 times the 1.75 divided by 100, you get the 1268. Since property taxes are calculated annually, we need to determine the daily tax amount. So assuming a 365 day year, daily tax is 1268 divided by 365 days, gets you 3.4. And now you want to calculate the seller's portion. So the property sale closed on March 21st, which is the 80th day of the year. January has 31 days. February has 28 days. March has 21 days up to the closing date. The seller is responsible for property taxes from January 1st to March 21st. So you're going to multiply the daily tax amount by the number of days the seller owns the property. So seller's portion is 80 days times 3.4. That was the daily tax. You get 278. Okay, so round that to the closest one, which is C. So again, the seller is responsible for property taxes from January 1st to March 1st. So that is going to be a debit. Debit from the seller. So does the seller get a credit from January to March? No, because they're responsible for paying those. So they would get a debit. Right? So real estate sale was closed on March 21st. The assessed value of the property is $72,500. The tax rate is $1.75 per $100 of assessed value. What is the proper entry on the seller's settlement statement? So we'll calculate the annual property tax. Annual tax is going to be the $72,500 times the 1.75 divided by the 100 gives you 1268. Then you calculate the daily tax, and then you get the seller's portion, and you round up to a close answer. An apartment has 2 units at $900 per month each, and 2 units at $550 per month each. The rents are paid the first of the month in advance, and the close of escrow is June 10th. How much will the buyer receive? Bravo, 2030. So here you want to calculate the total monthly rent. So you have a $900 unit. There's 2 of them. Then the total monthly rent for the $550 unit, and there's 2 of them. You add those together, you get the total monthly rent, which is $2,900. Then you want to determine the daily rent. So take $2,900 divided by 30 days, you get $96. Then you calculate the rent amount owed to the buyer. So take 20 times 96, you get $1,900. Round to match answer choices. So the closest answer to this calculation is approximately $2,000. Apartment has 2 units at 900 and 2 units at 500 per month each. The rents are paid the first of the month in advance, and the close of escrow is June 10th. How much will the buyer receive? So first things first, take the 2 units times 900, takes 2 units times 550, add them together to get the total, then divide it by 30 to get it in days. The close of escrow is going to be when? Is June 10th. So the buyer will receive rent from June 11th to June 30th, right? It's about 20 days. Multiply the daily rent by the number of days the buyer will own the property. So 20 days times 96, that's 1933.4. And then round that to the closest one, which is 2030. What is a prorated rent on an apartment which rents for $600 per month and the tenant moves in on September 11th? It is, Charlie, $200. $200. I'm sorry. Charlie's $400. $400. $400. So let's determine the daily rent. So the rent was $600 divided by 30 days. You get $20 per day. That's the daily rent. Calculate number of days the tenant will occupy. So the tenant moves in on September 11th. So they're going to occupy the apartment for the remainder of the month. So it's 30 days minus 10 is 20 days remaining in September, right? So there's 30 days in September, and so 20 days are remaining in September. 30 minus 10 is 20 days remaining. So you calculate the prorated rent. So multiply the daily rent by the number of days the tenant will occupy. So $20 per day times 20 days, that's $400. So what's the prorated rent on an apartment which rents for $600 per month and the tenant moves in on September 11th? So if you're going to rent rooms, you need to know how to do this calculation. Prorated rents, right? Because usually rents, prorated rent. So here they're moving in on September 11th. So what's the daily rent? So $600 divided by 30. There's 30 days. That's $20 per day. This tenant moves in on September 11th. They will occupy the apartment for the remainder of the month. So there are 30 days minus 10. Right, so you don't count the 11th day. So 20. So they're gonna move in on the 11th, right? So they haven't moved in yet. So 30 minus 20 is 20 days remaining in September. Okay, so now the daily rent was $20 per, and they're gonna be in there for 20 days, so that's $400. So they don't have to pay the full $600 rent. That would start on the first of the month next month, because they were in there the whole month. You are closing an escrow at the end of the month on a fourplex. The rents are $500 per month per apartment. Each unit has a security deposit of $200 held with the landlord. Which of the following is true? Bravo. Debit the seller $800. Debit seller $800. Debit seller $800. So property is a fourplex, meaning it has 4 units. Rent per unit per month is $500. Each unit has a security deposit of $200 held with the landlord. So the question is asking about the correct accounting entry regarding the security deposit. So since each unit security deposit is $200, 4 units times $200 per unit, it's $800. $800 security deposit, it's money held by the seller that needs to be transferred to the buyer at closing. Therefore, it would be debited to the seller. Debited to the seller, as they need to account for this liability to the buyer. So you're closing escrow at the end of the month on a fourplex. The rents are $500 per month per apartment. Each unit has a security deposit of $200 held with the landlord. Which of the following is true? So debit the seller $800. So here, question asking about the correct accounting entry regarding the security deposit when closing escrow. So each unit's security deposit is $200. So right away, they tell you security deposit is $200 and there's 4 units. So 4 times 2, that's $800 in security deposit, right? And security deposit is money held by the seller that needs to be transferred to the buyer at closing. Therefore, it would be debited to the seller, right? Because that seller needs to give that money that is going to be the tenant's money after, when they move out, if everything's okay. But they debit the seller the $800 for the security deposit. So, as they need to account for the liability to the buyer. So, at close of escrow, debit the seller $800 from via the security deposit. So, you are closing an escrow at the end of the month on a fourplex. The rents are $500 per month per apartment. Each unit has a security deposit of $200 held with the landlord. Which of the following is true? So again, you got 4 units, fourplex, security deposit $200, 4 times 2 is $800, and that seller needs to give that to the buyer at the end of the close of escrow. So debit the seller $800. What is the maximum amount of capital gain that a married couple can exclude from the sale of a principal residence? Charlie, $500,000. $500,000. $500,000. So single people is $250,000. Married people, for capital gain tax, $500,000. So primary criteria for this exclusion include ownership and use test. So the couple must have owned and lived in the home as their primary residence for at least 2 out of the 5 years. No recent exclusion. They must not have claimed the capital gains exclusion on another home within the past 2 years. So what's the max amount of capital gain that a married couple can exclude from the sale of a principal residence? So under the current United States tax code, a married couple filing jointly can exclude up to $500,000 of capital gains from the sale of their primary residence, provided they meet the criteria, right? Ownership and use, and no recent exclusion. Maximum amount of capital gain that a married couple can exclude from the sale of a principal residence. 500,000. 500,000. 500,000. The maximum amount of capital gain that a married couple can exclude from the sale of a principal residence is based on the United States tax code. Under the current U.S. tax code, a married couple filing jointly can exclude up to $500,000 of capital gains from the sale of their primary residence, provided they meet certain criteria. The primary criteria for this exclusion include ownership and use test. The couple must have owned and lived in the home as their primary residence for at least 2 of the last 5 years before the sale. No recent exclusion. They must not have claimed the capital gain exclusion on another home within the past 2 years. 3 years ago, an office was purchased for $1.5 million. The owner has made $250,000 in capital improvements and has depreciated the improvements a total of $175,000. What is the owner's adjustment basis? C, 1.575 million. 1.5 million. 1.575 million. All right, so 3 years ago, an office building was purchased for $1.5 million. The owner has made $250,000 in capital improvements and has depreciated the improvements a total of $175,000. What is the owner's adjusted basis? All right, so to calculate the owner's adjusted basis, we start with the original purchase price. You add the capital improvements and then subtract the depreciation. So the original price was $1.5 million. The capital improvements was $250,000. The total depreciation is $175,000. The formula for the adjusted basis is equal to the original purchase price plus the capital improvements minus the depreciation. Original purchase price plus the capital improvements minus the depreciation. So original purchase price plus the capital improvements minus depreciation. That is the adjusted basis. So again, adjusted basis is original purchase price plus the capital improvements minus depreciation. So adjusted basis is going to be the 1.5 million plus the capital improvements, which is 250,000, and then you subtract the depreciation, which is 175,000. So you calculate the sum of the purchase price and the improvements. So 1.5 million plus 250,000 equals 1.75 million. All right, so now you subtract the depreciation. 1.75 million minus 175,000 equals 1.5 million. 1.575 million. All right, 3 years ago, an office building was purchased for $1.5 million. The owner has made $250,000 in capital improvements and has depreciated the improvements a total of $175,000. What is the owner's adjusted basis? So first, you got to do what's a formula for adjusted basis. It's going to be the original purchase price plus the capital improvement minus the depreciation. Original purchase price plus the capital improvements minus depreciation. So the original purchase price 1.5 million plus the capital improvement, which is plus the capital improvement. So you get 1.75 and then minus the 75,000 depreciation. So let's do this. So adjusted basis is original purchase price plus the capital improvements minus the depreciation. So 1.5 million plus 250,000 minus the 175,000 That'll give you your adjusted basis. So you calculate the sum of the purchase price and improvements, you subtract the depreciation, and you're left with 1.575 million. Just one equation. Adjusted basis is the original purchase price plus the capital improvements minus the depreciation. All right, so 3 years ago, an office building was purchased for 1.5 million. The owner has made $250,000 in capital improvements and has depreciated the improvements a total of 175,000. What is the owner's adjusted basis? Adjusted basis. Well, adjusted basis is the original purchase price plus the improvements minus the depreciation. So 1.5 million plus 250,000, that's 1.75 million minus 175,000. Brings it down to 1.575 million. In the same year, a taxpayer has long-term capital gains totaling $150,000 and capital losses of $125,000. The taxable capital gain income for the year is $25,000. So in the same year, a taxpayer has long-term capital gains totaling $150,000 and capital losses of $125,000. The taxable capital gain income for the year is $25,000. So to calculate the taxable gain income, we need to subtract the capital losses from the capital gains, right? It's usually that fact. How much you have minus how much, the loss, and that's the long-term capital gains. So your long-term capital gains was 150,000. Your capital losses was 125,000. So the formula to find the taxable capital gain income is going to be this. Taxable capital gain income is going to be equal to capital gains minus capital losses. So what was the gain? 150,000. What's the loss? 125,000. So what's the total capital gain income? 25,000. Pretty straightforward. All right, in the same year, a taxpayer has long-term capital gains totaling $150,000 and capital losses of $125,000. The taxable capital gain income for the year is 25,000. So how do you do it? So if you want to calculate the taxable capital gain is just what your capital gain minus the capital loss. 150,000 minus 125,000 is 25,000. So the long-term capital gains, 150,000. Your capital losses, 125,000. So the formula to find the taxable capital gain income is going to be equal to capital gains minus capital losses. Capital gains minus capital losses. So 150,000 is capital gain, 125,000 capital loss. You subtract them, you get the taxable capital gain income. In the same year, a taxpayer has long-term capital gains totaling $150,000 and capital losses of $125,000. The taxable capital gain income for the year is $25,000. So to calculate the total capital gain income, it's 150 minus 125 gives you 25, and that's the total capital gain income for the year. On a personal residence, what is the maximum loan amount on which interest may be deducted for tax purposes? On a personal residence, what is the maximum loan amount on which interest may be deducted for tax purposes? It is Charlie, $750,000. $750,000. $750,000. So on a personal residence, what's the maximum loan amount on which interest may be deducted for tax purposes? So the question is asking for the maximum loan amount on a personal residence for which interest may be deducted for tax purposes. As of recent tax laws in the United States, for mortgages taken out after December 15, 2017, the maximum loan amount on which interest is deductible is $750,000 for individuals filing jointly. This limit is lower than the previous limit of $1 million, which applies to mortgages taken out before that date. All right, so on a personal residence, what's the maximum loan amount on which interest may be deducted for tax purposes? So as of recent tax laws in the United States, for mortgages taken out after December 15, 2017, the max loan amount on which interest is deductible is $750,000 for individuals filing jointly. This limit is lower than the previous limit of $1 million, which applies to mortgages taken out before that date. On a personal residence, what is the maximum loan amount on which interest may be deducted for tax purposes? So as a recent tax laws in the United States, for mortgages taken out after December 15, 2017, the maximum loan amount on which interest is deductible is $750,000 for individuals filing jointly. This limit is lower than the previous limit of $1 million, which applies to mortgages taken out before that date. A property with an adjusted basis of $1.75 million is sold for $2.5 million. At the end of 5 years, if the cost of sale were $160,000, what is the owner's capital gain? So $590,000. $590,000. So to calculate the capital gain on the property, let's break down the details provided and the steps needed. So sale price 2.5, the sold for 2.5 million. The adjusted basis is 1.75 million. The cost of the sale, if the cost of the sale were 1.6 million, what's the owner's capital gain? So calculate total basis. So total cost basis includes an adjusted basis and the cost of sale. So the total cost basis equals the adjusted basis plus the cost of sale. So total cost basis equals adjusted basis plus the cost of the sale. Total cost basis equals adjusted basis plus cost of the sale. So 1.75 million plus 160,000, that'll give you 1.91 million. That'll be the total cost basis. Step 2, calculate the capital gain. So the capital gain is the difference between the sales price and the total cost basis. So again, capital gain equals the sale price minus total cost basis. So what is the sale price? 2.5 million. What's the total cost basis? 1.91 million. So capital gain is the 2.5 million minus the total cost basis of 1.91 million, which gives you $590,000. All right, a property with an adjusted basis of 1.75 million is sold for 2.5 million at the end of the 5 years. If the cost of the sale were 160,000, what's the owner's capital gain? So you want to calculate the total cost basis. Total cost basis is equal to adjusted basis plus the cost of the sale. So 1.750 million plus 160,000 is 1.91 million. So the capital gain is going to be the sale price minus the total cost basis. So sale price is 2.5 million minus 1.91 million to get you 590,000. So a property with an adjusted basis, 1.75 million, is sold for 2.5 million at the end of 5 years. If the cost of sale were $160,000, what's the owner's capital gain? So take the total cost basis, which is equal to adjusted basis plus the cost of sale. So 1.75 million plus 160,000 equals 1.91 million. So capital gain is equal to the sale price minus the total cost basis. So 2.5 million minus 1.9 million is 590,000. What is the minimum dollar amount of improvements that requires an owner who intends to sell or lease the property to use a licensed contractor? Bravo, $1,000. $1,000. $1,000. So what's the minimum dollar amount of improvements that requires an owner who intends to sell or lease the property to use a licensed contractor? $1,000. That's the minimum dollar amount of improvements that requires an owner who intends to sell or lease the property to use a licensed contractor. Okay, according to general contractor licensing laws, many states require that if the cost of improvements or repairs exceeds a certain amount, often it's $1,000, a licensed contractor must be used. Here, answer B, $1,000 is often the minimum threshold for when a licensed contractor is required for improvements on a property intended for sale or lease. So the minimum dollar amount of improvements that requires an owner who intends to sell or lease the property to use a licensed contractor is $1,000. Liens on a property exist as follows. Delinquent property taxes is $5,000. Okay, what is the minimum dollar amount of improvements that requires an owner who intends to sell or lease the property to use a licensed contractor? Bravo, 1,000. $1,000. $1,000. So, according to general contractor licensing laws, many states require that if the cost of improvements or repairs exceeds a certain amount, often $1,000, a licensed contractor must be used. So, what's the minimum dollar amount of improvements that requires an owner who intends to sell or lease the property to use a licensed contractor? $1,000. Liens on a property exist as follows: delinquent property taxes, $5,000. First deed of trust, $150,000. Second deed of trust, $50,000. If the second deed of trust is foreclosed, how much money must the foreclosure sale bring in order for the second deed of trust beneficiary to be paid in full? Alpha, $50,000. $50,000. $50,000. So the question provides a property with the following liens. So the delinquent property taxes is $5,000. The first deed of trust is $150,000. The second deed of trust is $50,000. It asks how much money the foreclosure sale must bring in for the second deed of trust beneficiary to be paid in full. So the order of payments in foreclosure. So let's go over the explanation of the calculations. So in a foreclosure, liens are generally paid in order of priority. So number one thing here is always property taxes, right? That's the number one thing you pay first. So, when you have a lien against your property, you gotta pay property tax first. So property taxes are usually the highest priority, usually paid first. The first deed of trust comes next. Second deed of trust is paid after these are cleared, provided they are remaining funds. The amount needed to cover higher priority liens. So the property must first cover the delinquent property taxes of $5,000, right? That's what you got to cover first. Next, it must cover the first deed of trust, which is $150,000, and then the total to cover these priority liens is going to be the $5,000 plus the $150,000 is $155,000. So, in conclusion, for the second deed of trust beneficiary to be paid in full, the foreclosure sale must bring in at least $155,000. So liens on a property exist as follows: delinquent property taxes, $5,000. First deed of trust, $150,000. Second deed of trust, $50,000. If the second, right, the $50,000, if the second deed of trust is foreclosed, how much money must the foreclosure sale bring in order for the second deed of trust beneficiary to be paid in full? So, since the correct answer given is A, 50,000, it's clear that only $50,000 needs to be brought. So you got to pay your property tax first, which is 5,000. Then you got to pay the first deed of trust, 150,000. So it needs to bring in at least 50,000. So it asks how much money the foreclosure sale must bring in for the second deed of trust beneficiary to be paid in full. Well, at least 50 grand. Okay, so amount needs to cover high priority liens. The property must first cover the delinquent property taxes of 5,000. Next, it must cover the first deed of trust, which is $150,000. Then the total to cover these priority liens is 5 plus the 150 is $155,000. So liens on a property exist as follows: delinquent property taxes $5,000, first deed of trust is $150,000, the second deed of trust is $50,000. If the second deed of trust is foreclosed, how much money must the foreclosure sale bring in for the second deed of trust beneficiary to be paid in full? Well, it needs at least 50 grand for the second beneficiary to be paid in full for the second deed of trust. What are the semi-annual taxes on a Class 1 property that has a full cash value of $1 million and a limited value of $950,000 if the tax rate is $20 per $100 of the assessed value? Answer is A, $17,100. $17,100. $17,100. So what are the semi-annual taxes on a Class 1 property that has a full cash value of $1 million and a limited value of $950,000 if the tax rate is $20 per $100 of assessed value? So here we have the limited value of the property, which was given as $950,000. The tax rate is $20 per $100 of assessed value. The semi-annual taxes, this means we'll be calculating taxes for half of the year, so we'll divide the annual tax amount by 2. So you want to calculate the annual tax. So since the tax rate is $20 per $100 of the assessed value, we first need to determine the tax on $950,000. So you want to convert $950,000 into units of $100 by dividing by 100. So take $950,000 divided by 100. That gives you what? So knock out 2 zeros. That gives you $9,500. Multiply this by the tax rate. That's $20 per $100. So 9,500 times 20 divided by 100. So you get $190,000. So that's the annual tax. So the annual tax is $190,000. So we had to calculate the annual tax, and then we got the annual tax, $190,000. So now let's calculate the semi-annual tax. So you'll divide the annual tax by 2 to get the semi-annual tax. So $190,000 divided by 2, that's going to be equal to $95,000. So thus the semi-annual tax on this property should be $95,000. It appears there might have been a misunderstanding in selecting the answer, as $17,100 was marked as the correct choice, suggesting a potential error in either tax rate or assessed details given in this question. So again, what are the semi-annual taxes on a Class 1 property that has a full cash value of $1 million and a limited value of $950,000 if the tax rate is $20 per $100 of assessed value? So first things first, let's calculate the annual tax. So what we're given is the limited value of the property is $950,000. Then you divide it by 100, so you get $9,500. And you multiply this by the tax rate, $20 over 100, you get $190,000. Okay, that's the annual taxes. So you want the semi-annual, so you divide it by 2, so you get $95,000. So what are the semi-annual taxes on a Class 1 property that has a full cash value of $1 million and a limited value of $950,000 if the tax rate is $20 per $100 of assessed value? So here again, you want to get the annual tax, and then you divide it by 2 to get the semi-annual tax. So the annual tax, let's start with that. So the limited value of the property. So to calculate the semi-annual taxes on a Class 1 property, let's go through the information and steps provided. So the limited value of the property is $950,000. The tax rate is $20 per $100 of assessed value. The semi-annual taxes, this means we'll be calculating taxes for half of the year. So we'll divide the annual tax amount by 2. So first, let's calculate the annual tax. The annual tax on, you want to convert the limited value of the property, $950,000, into units of $100. So by dividing by 100, so $950,000 divided by 100 multiplied by 20, that's the annual tax. So you take the limited value of the property, $950,000, multiplied by the tax rate, $950,000 times 20 divided by 100 to get the annual tax. And then you just divide it by 2, you get $95,000. So what are the semi-annual taxes on a Class 1 property that has a full cash value of $1 million and a limited value of $950,000 if the tax rate is $20 per $100 of the assessed value? So take $950,000 times 20 divided by 100, you get the annual tax, divided by 2, you get the semi-annual tax. A tax reduction A tax reduction for state aid to education is given to which property class? Class 3. Class 3. Class 3. A tax reduction for state aid to education is given to which property class? Class 3. So the question asks about which property class receives a tax reduction for state aid to education, with the correct answer being Class 3. So in property classification systems, certain classes may receive tax reductions or exemptions based on the property type or purpose, such as education, agriculture, or public use. For educational purposes, specific property classes, such as Class 3, are designated to receive favorable tax treatments, often to encourage public and private investments in education. In this case, it appears that a Class 3 is the category designated by the state or local tax authority for properties that benefit from tax reductions related to state aid for educational purposes, leading to the correct answer, C, Class 3. This answer is based on the classifications provided by the local tax laws and may vary by jurisdiction. So a tax reduction for state aid to education is given to which property class? So in property classification systems, certain classes may receive tax reductions or exemptions based on the property type or purpose, such as education, agriculture, or public use. For educational purposes, specific property classes, such as Class 3, are designated to receive favorable tax treatments, often to encourage public and private investments in education. So, tax reduction for state aid to education is given to which property class? It is Class 3. So, in this case, it appears Class 3 is a category designated by the state or local tax authority for properties that benefit from tax reductions related to state aid for educational purposes. A Class 2 parcel has a full cash value of $100,000 and a limited value of $90,000. If the tax rate is $18.50 per $100 of assessed value, what are the annual taxes? Alpha 2497.5. 2497.5. 2497.5. So to calculate the annual property taxes for this Class 2 parcel, we need to apply the tax rate to the assessed value. So here are the details. The limited value, which is the assessed value. So again, a Class 2 parcel has a full cash value of $100,000 and a limited value of $90,000. So the assessed value is based on the limited value, which is $90,000. So the tax rate is $18.5 per $100 of assessed value, and they're telling you right here the limited value, which is the assessed value, and on that assessed value, it's the tax rate is 18.5 per $100 of the assessed value, not of the cash value. So you want to convert the tax rate. The tax rate of 18.5 per $100 means that for every $100 of assessed value, $18.5 is charged in taxes. So to simply divide 18.5 by 100 to find the tax rate as a decimal. So the tax rate is going to be 18.5 divided by 100 is equal to 0.185. So now you want to calculate the annual taxes. So multiply the assessed value of $90,000 by the tax rate of that 0.185. So you get annual taxes is 90,000 times 0.185. You get 16,650. So 16,650 is correct based on this calculation, but the provided answer marked A, 2497, seems incorrect if following these steps and using the given values. So if the official answer states 2497.5, it's possible that there's an error in the question's information or assumptions not clarified here. Based on standard interpretation, C, 16,650 is consistent with the provided value as and calculation. which of the following property classifications requires the owner to file a rental property registration form with the county assessor? Delta. Class 4. So class 3 gives you the tax reduction for education. Class 4 is a property classification requires the owner to file a rental property registration form with the county assessor. So which of the following property classifications requires the owner to file a rental property registration form with the county assessor? Class 4. Class 4. Class 4. So class 4 requires the owner to file rental property registration form with the county assessor. So determine why class 4 is correct. So we need to understand property classification system and the requirements for each class regarding rental property registration. So generally, property classifications varies by state or jurisdiction, but common property classes often include class 1, which is residential, and that's often owner-occupied homes. Right? So class 1 is residential, owner-occupied homes. Class 2 is going to be agriculture or farmland. So class 2 is agriculture or farmland. Class 2 is agriculture or farmland. Class 3 is commercial or industrial properties. Class 3 is commercial or industrial properties. Class 3 is commercial or industrial properties. Class 4 is residential rental properties. So class 1 and 4 are kind of like on the extreme spectrums. Class 1 is just residential. Class 4 is residential rental properties. So class 1, most of us live in single family owner occupied homes or something of that aspect. And if you rent, most of us live in the residential rental properties. So sometimes non-owner occupied or rental residential properties. So class 2 is agriculture. So class 1 residential, class 2 agriculture, class 3 is commercial, class 4 is residential rental. So for jurisdictions where a rental property registration form is required, this typically applies to properties designated for rental purposes rather than owner-occupied properties. So in many cases, class 4 represents properties used for residential rental purposes. So owners of these properties would be required to file a registration form to indicate that the property is being used as a rental. So based on this classification, the requirements for a rental property registration form would apply to class 4 properties, making answer D correct. All right, which of the following property classifications requires the owner to file a rental property registration form with the county assessor? So determine why class 4 is correct. We need to understand the property classification system and the requirements for each class regarding rental property registration. So generally, property classification varies by state or jurisdiction, but common property classes often include this. So class 1 is what? Residential, often owner-occupied, so single-family homes, class 1. Class 2 is going to be agriculture or farmland. Class 2 is agriculture or farmland. Class 3 is going to be commercial or industrial properties. So class 3 is commercial or industrial properties. Class 3 is commercial or industrial properties. So, if it's a school, that's commercial or industrial, and they'll get the tax write-off. But you'll notice a Class 3, if it's a Class 3 property, it's going to be a business, something like that. Class 4 properties are going to be classified as just residential rental properties. So anything to dealing with rental property registration form is going to be with a Class 4 property class. Which of the following property classifications requires the owner to file a rental property registration form with the county assessor? So that's going to be Class 4, which deals with residential rental. Class 1 is just residential. Class 2 is agriculture or farmland. Class 3 is commercial properties, and Class 4 is residential rental. So because Class 4 is residential rental property registration form would be filed with that. In Arizona, the tax assessment rate on a single-family owner-occupied home is, bravo, 10%. 10%. 10%. In Arizona, the tax assessment rate on a single-family owner-occupied home is 10%. So the question asks about the tax assessment rate for a single-family owner-occupied home in Arizona. The options provided are 9, 10, 12, 14. Correct answers: B, 10%, as indicated in the response. This is based on Arizona property tax law, which typically assesses the residential owner-occupied properties, also known as a Class 3 property. So, at a rate of 10%. So this rate is used by the state to determine the assessed value for property tax purposes, where the assessed value equals 10% of the property's full cash value or limited property value, whichever is applicable. The tax is then calculated by applying the property tax rate to this assessed value. So in Arizona, tax assessment rate on a single family home owner occupied with Class 1 is 10%. In Arizona, tax assessment rate on a single family owner occupied home is, bravo. So this is based on Arizona property tax law, which is typically assesses residential owner-occupied properties, also known as Class 3. I think it's Class 1, actually, at a rate of 10%. So in Arizona, the tax assessment rate on a single-family owner-occupied home is 10%, based on Arizona tax law. Right? Interest rate on delinquent property taxes in Arizona is, Charlie, 16%. 16%. 16%. So interest rate on delinquent property taxes in Arizona is 16%. So this question asks about the interest rate applied to delinquent property taxes in Arizona. In Arizona, the statutory interest rate on delinquent property taxes is 16% per year. So in Arizona, the statutory interest rate on delinquent property taxes is 16% per year. The statutory interest rate on delinquent property taxes is 16% per year. This rate is set by the law and does not require calculation. It's a fixed rate applied to overdue property tax amounts until the taxes are paid or the property goes through a tax lien sale. Is 16%. 16%. So if you're late on your property taxes, right, delinquent or late, whether they put the interest rate on your property taxes. So say you're late, you owe $5,000 on property taxes per year, you're gonna have to pay $5,000 plus 16% on your property tax. So 16%. So in Arizona, the statutory interest rate on delinquent property taxes is 16% per year. This rate is set by law. It does not require calculation. It's just a fixed rate applied to overdue property tax amount until taxes are paid or the property goes through a tax lien sale. So interest rate on delinquent property taxes in Arizona is 16%, right? In Arizona, the statutory interest rate on delinquent property taxes is 16% per year. This rate is set by law and does not require calculation. So the interest rate on delinquent property taxes in Arizona is 16%. So it's set by the law. It's a fixed rate. There's no calculation on this. The delinquency dates on real property taxes are November 1st and May 1st. November 1st and May 1st. November 1st and May 1st. So you can remember this, right? School ends in May, right? So real property taxes, they're due when school ends in May, right? May 1st. And delinquency, right? When it becomes late, November, right? So think about after Halloween, right? After October is November. So on November 1st, what happens? That's the delinquency date on real property taxes. That's when it becomes late, delinquent. So November, after Halloween, and then at the end of school. End of Halloween, end of school. Think about it like that. End of Halloween, November, the end of school. Everyone, summer starts always, at the end of May, right? For university, high school, college, we end in May, right? So at the end of school, that's when property taxes become due, right? That's when delinquency dates on real property taxes. So end of Halloween, November 1st and May 1st. 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 So the question asks for delinquency dates on real property taxes. The answer choices are November 1st and May 1st. In Arizona, property taxes are generally due in 2 installments. Right? They're generally due in 2 installments. Here's how it typically works. The first half of the tax year payments is due on October 1st and becomes delinquent if not paid by November 1st. So when is it due? October. If you don't pay it by November 1st, when is it delinquent? November 1st. The second half of the tax year's payment is due on March 1st. And it becomes delinquent if it's not paid by May 1st, right? So the end of Halloween, it's delinquent, November 1st, and the end of when school gets out, May 1st. This explains why the correct answer is November 1st and May 1st. These are the dates when taxes become delinquent if not paid on time. And if you don't pay your property tax on time, what is the tax rate? 16%. The delinquency dates on real property taxes are November 1st and May 1st. So in Arizona, property taxes are generally paid in 2 installments. Here's how it typically works. The first half of the tax year's payment is due on October 1st, and it becomes delinquent if not paid by November 1st. The second half of the tax year's payment is due on March 1st of the following year and becomes delinquent if not paid by May 1st. The delinquency dates on real property taxes are, so in Arizona, the property taxes are generally due in 2 installments. So the first half of the year is due on October 1st and becomes delinquent if not paid by November 1st. The second half of the year's installment payment is due on March 1st of the following year and it becomes delinquent if it's not paid by May 1st. Real estate taxes are due March 1st and October 1st. March 1st and October 1st. March 1st and October 1st. So to understand why March 1st and October 1st is correct for the due dates of real estate taxes, we need to look at the typical tax payment schedules used by various jurisdictions. In many places in the United States, real property taxes are due in 2 installments with common due dates in March and October. The schedule allows taxpayers to pay payments twice a year, often in early spring and early fall, which are common periods for tax deadlines. Here's how the options generally break down. So March 1st and October 1st, this is common schedule for property tax payments in some states. So Monday in January, this is typically not a typical date. Aligns with the standard due dates for property taxes in many regions. So real estate taxes are due in March, right, and October 1st. So I like to think about it as, beginning of Halloween and the beginning of the end of the school year. So beginning of Halloween, October 1st. If you don't get it, they become delinquent on when? November 1st. And when the end of school starts May 1st is when it becomes delinquent, but it opens up in a couple months before the end of the school year. So January, February, March, April, May. So about 3 months before the end of that school year. So March 1st and October 1st. In Arizona, taxes become a lien against real property on January 1st. January 1st. January 1st. So in Arizona, taxes become a lien against real property on January 1st. The beginning of the year, January 1st. So in Arizona, property taxes become a lien on real property starting on January 1st of each year. This is a statutory date when unpaid taxes from the previous year becomes a legal claim against the property. Here's a breakdown of the key points. So lien date. So property taxes become a lien on real property in Arizona on January 1st. This means that on this date, if property taxes remain unpaid, they are officially recorded as a lien against the property. Answer verification. In this question, option D, January 1st, is the correct answer as per Arizona law. This is why the given answer is D. So the calculation or reasoning here is based on statutory knowledge, not a numerical calculation. So something you got to memorize. Right? So statutory is the knowledge, the wisdom that you put into your brain. So in Arizona, taxes become a lien against real property on January 1st. So the lien date, property taxes become a lien on real property in Arizona on January 1st. This means that on this date, if property taxes remain unpaid, they are officially recorded as a lien against the property. So in Arizona, taxes become a lien against real property. In Arizona, property taxes become a lien on real property starting on January 1st of each year. This is a statutory date when unpaid taxes from the previous year become a legal claim against the property. Vacant commercial land in Arizona is taxed at what percent of value? 15%. Bravo! 15%. 15%. 15%. So vacant commercial land, vacant, right? Nobody's living there, and it's a business, commercial land in Arizona is taxed at what percent of value? 15%. Property taxes, right? When they're delinquent, what's the tax rate? 16%. Vacant commercial land is going to be taxed at what percent? 15. So these are high interest rate numbers, high tax rate numbers. So in Arizona, vacant commercial land is typically assessed at 15% of its value. Vacant commercial land is typically assessed at 15% of its value. This percentage represents the assessment ratio, which is used to determine the taxable assessed value of the property. The property's market value is multiplied by this assessment ratio to calculate the assessed value on which property taxes are then based. So this is why the correct answer is 15%. Vacant commercial land in Arizona is taxed at what percent of value? So in Arizona, vacant commercial land is typically assessed at 15% of its value. So vacant commercial land. So you want to start a McDonald's, right? You buy some land, commercial land. What are they going to tax you on the land? It's commercial and it's vacant. It's 15%. 15. It's kind of high. This percentage represents the assessment ratio, which is used to determine the taxable assessed value of the property. So vacant commercial land in Arizona is taxed at what percent of value? In Arizona, vacant commercial land is typically assessed at 15% of its value. A contractor is building a patio. A lumber company delivers bricks on July 1st, and work begins that same day. Work is completed on August 15th. The contractor is paid for labor and materials on September 1st. 10 days later, the contractor goes bankrupt without paying the lumber company. The lumber company records a mechanics lien on the property as of September 4th. The mechanics lien is effective as of Alpha July 1st. July 1st. July 1st. So it's whenever they start work is when the mechanics lien affects. So even if they filed it, 3 months later, it's effective on the day that the contractor, the lumber company, whenever the mechanics lien, whenever the contractor started the work. So in this scenario, we're dealing with the mechanics lien, which is a legal claim against a property by a contractor or supplier who has not been paid for work or materials. Here's how the answer is determined. The timeline of events. So on July 1st, The lumber company delivers materials and work begins on the patio. August 15th, the work is completed. September 1st, the contractor is paid, but soon after goes bankrupt without paying the lumber company. September 4th, the lumber company records mechanics lien. Mechanics lien effective date. Here's the main important point. The main jurisdiction of mechanics lien is effective from the date work or materials were first provided on the project, not when the lien is recorded. So for mechanics lien, it's whenever they started to do work, whenever they bought stuff, brought it to the on-site, that's when the mechanics lien is effective, not whenever they got to filing it. In this case, the materials were delivered on July 1st and work started the same day, therefore July 1st is considered the effective date of the lien. So since the lien is retroactive to the start date of work or material delivery. So a contractor is building a patio. A lumber company delivers bricks. A lumber company delivers bricks on July 1st and work begins the same day. Work is completed on August 15th. Contractor is paid for labor and materials on September 1st. 10 days later, the contractor goes bankrupt without paying the lumber company. The lumber company records mechanics lien on the property as of September 4th. The mechanics lien is effective as of July 1st. So again, the materials were delivered on July 1st and work started that same day. Therefore, July 1st is considered the effective date of the lien. So for mechanics lien, it's the day the work started. Doesn't matter when they record it. It would be retroactively go back and be effective on the day they started work. A contractor is building a patio. Lumber company delivers bricks on July 1st and work begins that same day. Work is completed on August 15th. The contractor is paid for labor and materials on September 1st. 10 days later, the contractor goes bankrupt without paying the lumber company. The lumber company records mechanics lien on the property as of September 4th. The mechanics lien is effective as of July 1st, right? The materials were delivered on July 1st and work started that same day. Therefore, July 1st is considered the effective date of the lien. When a broker acting as a property manager receives monies, the funds must be deposited within how many banking days? Answer is C, 3. 3 days. 3 days. So a broker has about 3 banking days, right? Or immediately, but in general, 3 banking days to deposit funds. So standard banking day requirements. Many states' real estate and property management regulations require that brokers deposit, receive funds such as rents or security deposits into a trust account within a specified number of banking days. In this case, the regulation specifies 3 banking days. So when a broker acting as a property manager receives monies, the funds must be deposited within how many banking days? 3 banking days. So many states, real estate and property management regulations requires that brokers deposit, receive funds such as rent or security deposits into a trust account within a specified number of banking days. In this case, the regulation specifies 3 banking days. So you have a broker, so say you have commercial property and you hire a broker who's acting as your property manager. You give them the money for the rent or trust account. They have about 3 days to submit the money to the trust account. An apartment complex has 10 units. 6 units rent for $650 per month, and 4 units rent for $475 per month. Over the year, there's a 10% fallout rate, and the property manager receives an additional $175 for every new unit rented. If 4 units were rented and the manager receives a 5% commission on rents collected, what is the manager owed? Bravo, 3832. 3832. 3,832. So calculate the annual rent for each type of unit. So there's 6 units. They rent for $650 per month. So 6 units times $650 per month times 12 months to get it in years. So 6 times 650 times 12, that's 46,800. Now there's 4 units that rent for $475 per month. 4 units times $475 per month times 12 months. 4 times $475 times 12, that's 22,800. Total potential annual rent, 46,800 plus 22,800 is 69,600. So that's the total annual rent for the 6 units at 650 plus the 4 units at 475, right, to get it in annual. Then you wouldn't account for 10% fallout, right, vacancy rate, fallout rate, vacancy rate, how many people empty. So since there's a 10% fallout rate, only 90% of the total rent is actually collected. So 69,600 times 90% is 62,640, right? Because you have a 10% fallout rate, so you multiply by 90%, not 100%. 100% you have full occupancy, but typically we have 10% fallout rate, so you have a little built-in cushion. So 69,600 times 90%, you get 1640. That's accounting for the fallout vacancy. Now calculate the manager's 5% commission on that collected rent. So now you have a 62,640 times 5% or 0.05, you get $3,132, right? So that's to the manager. Now add additional fees for new rental. So the manager also receives an additional $175 for every new unit rented. So since 4 units were rented, 4 units times $175, that's $700 additional. So calculate the total amount owed to the manager is $31.32 plus the $700 gives you $38.32. So an apartment complex has 10 units. 6 units rent for $650 per month. 4 units rent for $475 per month, right, out of the 10 units. So you need to get the annual rent. So 6 times the 650 times 12, 4 units times the 475 times 12 is the annual. You add them together to get the total annual. Over the year, there's a 10% fallout rate. So they actually give you the vacancy rate. So you would take that monies, multiply by 90%, right? Because that's the 100%. It's not 100, it's 90% because you subtract that fallout rate. And the property manager receives an additional $175 for every new unit rented. If 4 new units were rented, right? So there you go, 175 times 4, right? Because that's how many new units were rented. That manager receives an additional compensation of $175 for every new unit they bring in. They brought in 4 new units for that year. The manager receives a 5% commission on rents collected, right? So we just calculated total annual rent. So, but that's after the fallout rate. In that year, they had a 10% fallout rate. So you get the annual times the fallout rate times the 5% gives you a number. You add in the 175 times the 4 units, add that together, you get 3332. So to calculate what the manager's owed, let's go through each component of the question step by step. So calculate the annual rent for each type of unit. So 6 units times 650 times 12, that gets you the annual rent. 4 units times 475 times 12 gives you the 22,800. So the total rent, potential annual rent is the 46,800 plus the 22,800 gives you 69,600. Multiply that by the 10%, by the 90% fallout rate. So it gets you 62,640 times 5% commission, and adding the 4 units times the 175 gets you 3832. An apartment complex has 10 units. 6 units rents for $650 per month, and 4 units rent for $475 per month. Over the year, there's a 10% fallout rate, and the property manager receives an additional $175 for every unit rented. If 4 units were rented and the manager receives a 5% commission on rents collected, what is the manager owed? So the manager's owed money. So first, to the property manager, you take 175 times 4. That's your additional bonus money because you got money for your new units that you rented. And you got to get the annual rent, $650 for 6 units times 12 gets annual. 4 units times 475 times 12 gets you that. Add that together, then multiply that by the 90% to get the total amount of money with fallout rate. Then multiply that by 5%. Add that to your 175 times the 4 units, you get 3832. So the 6 units brought in 46 grand. The 4 units brought in 22 grand. Okay, with the additional fallout rate, 62 grand. Multiplied by the commission of 5%, it's 3132. Add the 700, 3832. Which sections are contiguous to section 6? So 1 and 7. 1 and 7. 1 and 7. So contiguous means adjacent or next to. So right next to 6 is going to be 7. Right next to 6 is going to be 5. Okay. So contiguous, which is adjacent, which is next to. To be contiguous means they are directly next to section 6, right? In sequence. So typically on either side, it could be, if you say something is adjacent, which is next to you, it doesn't matter what side it is, as long as it's next to it. It's adjacent, the left side or right side. So therefore, we need to find sections directly before and after section 6. So section 5 comes immediately before section 6. Section 7 comes immediately after section 6. So sections 5 and 7 are contiguous, which is adjacent or next to. Okay, so which sections are contiguous to section 6, 1, and 7? Okay, a broker sold the southwest 1/4 of the southwest 1/4 of the southwest 1/4 and the west half of the northwest 1/4 of section 640, township 4, range 3 east. How many acres are included in the sale? All right, so 640 acres are in one section. So take 640 divided by 4, divided by 4, divided by 4. You get an answer. So we'll bust out the calculator. $640 divided by 4, 3 times divided by 4 divided